The market is reacting negatively to the tariff news and is currently down around 2% at 55.76. But today, I want to talk to you about how you can leverage and take advantage of this market volatility to build your wealth. It's worth noting, I am not a financial advisor. This is not meant to be a financial advice. Please consult with your financial advisor and tax specialist. This is just me sharing what I know, my experience. That's it. When you hear the news about how the market is performing, it's simply talk about the performances of the top 3 indexes. They are the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. But today I'm going to talk to you about the S&P 500. All it is tracking the top 5 U.S. publicly traded companies. And depending on how they perform, the index either go up or the index go down. There were 2 ways you can invest in S&P 500 index is either through mutual fund or ETF, which is exchange traded funds. The mutual funds that track S&P 500 are VINIX, which is Vanguard Institutional Index Fund Institutional Shares, or FIAIX, Fidelity 500 Index Fund, VIIX, or Vanguard Institutional Index Fund Institutional Plus Shares. These are the mutual funds that are available in most 401k plan or HSA suite. Another way you can invest in S&P 500 index, the top U.S. publicly traded company, is through exchange traded fund, which is also known as ETF. And those are VOO, which is Vanguard S&P 500 ETF, or IVV, which is iShare Core S&P 500 ETF, or SPY, which is Spider S&P 500 ETF Trust. And you can invest in those ETF through most discount brokerage firm like Robinhood, M1 Finance, Fidelity, Charles Schwab, etc. The difference between a mutual fund and an ETF, mutual fund is only traded 1 time per day at the close of the business day, and you actually have access to it either through the financial institution that created those funds or through your retirement account like a 401k, HSA, etc. As far as ETF, you can trade it like a stock. You can buy and sell any time of the day, any day of the week. And you have access to that through any of the discount brokerage firm like I mentioned earlier. One thing to keep in mind, if you invest outside of your retirement account, either a tax sheltered or tax deferred account, and you invest in individual brokerage account, also known as a taxable account, any dividends or realized gains is a taxable event. So make sure you file your tax properly. But outside of the tax difference, I'm going to show you some example and the performances of all of these mutual funds and ETF, how very similar they are. They have different names created by different companies, but they have the same function. They have the same purpose. They are set to passively track the performance of S&P 500 index. And as a retail investor, as someone who values long-term investing, I will show you the performances of all these funds and how close they are to each other. The market volatility is nothing new. We have experienced up, we have experienced down, we have experienced market up over 30%, we have experienced market down over 30%. If you look at S&P 500 from March 13, 1998 through March 14, 2025, that's a 27-year period. The reason I picked that time frame, 1998, was when I started working full time. And I ended to March 14 for this data point. If you look at the performance, daily performance, it is natural to see ups, to see downs. If you look at the market back in 1998, it was around 1100. But from 98 all the way through 2009, it's a lost decade. The market did not perform well at all. As a matter of fact, you lost money during that 11, 12 years. But dollar cost average on a weekly basis, you now accumulate a lot of shares, and when the market goes back up, you have all that shares to grow your wealth. So that's the S&P 500 index. Now if you look at the VINIX, which is a mutual fund that tracks an S&P 500 with the same time frame, you notice these similarities. For the S&P 500 index, to the VINIX, it's essentially the same graph. Yes, they have the different closing price because how they are structured, but overall, because VINIX, along with other mutual funds and ETF that track S&P 500, their performances is almost identical to the actual S&P 500 index. Now that we get that out of the way, here are the list of 500 U.S. companies that are in S&P 500 index. Apple, Microsoft, Nvidia, Amazon, Visa, MasterCard, Costco, Netflix, you name it. These are all the companies that are in S&P 500 index. So how they perform will reflect in the S&P 500 index. VINIX, Vanguard Institutional Index Institutional Share, which tracks S&P 500, all it is, if you look at the list of their holdings, it has the same companies in the S&P 500 index. The difference is the percent weighted and how many shares the fund owns. So in this case, VINIX has 7.24% of the fund in Apple, 6.07% in Nvidia, 5.85% in Microsoft, etc. And if you look at VU, which is an ETF that tracks S&P 500 index, it has the same list of companies. 7.25% is in Apple, 6.8% in Nvidia, etc. Now you look at SPY, which is ETF that tracks S&P 500 index. Again, the same list of company. The difference is just a slight difference in the percent weighted and number of shares the fund owns for each of these companies. Because these mutual funds and ETF simply track the performance of S&P 500 index, they are considered a passively managed fund. Their expense ratio is fairly low as well. So if you look at VINIX, the expense ratio is 0.03%, very low. Compared to actively managed fund, you're looking at 0.75 to over a point. You look at VOO, expense ratio is 0.03%. SPY, the expense ratio is 0.09%, which is slightly higher than the other index fund. And if you have questions on any of the terminologies, I have a 401k Millionaire series that I explain what all those financial terms mean. If you have any question, please refer to it. Now you know S&P 500 index simply contains the top 500 U.S. publicly traded companies, and you have different mutual funds and different ETF that simply track the S&P 500 index. And you can have access to the mutual fund through your retirement plan or ETF through any of the discount brokerage firm like Robinhood, M1 Finance, and Charles Schwab, etc. Now let's take a look at their performance just to show you how similar they are. Testful.io is a great free tool and it has many use cases, but one of the many use cases is to see the historical performance of a particular fund or multiple funds. So in this case, I put in the starting date of March 1398 through March 14, 2025, so a 27-year period. Starting value of $1, cash flow of $100 a week on a weekly basis. You can put it monthly or yearly. And the reason I put $100 a week, that's $400 a month. If I have to be frank with you, from my working career, even when I was an hourly production employee, I can't 100% afford $100 a week or $400 a month. That's just a car payment. And then you can put in the different ticker symbol. So VINIX, FXAIX, VIIIX, VU, and SPY. One thing to note, even though I put 1998 as the beginning date, because I put 5 different funds, the result will limit, if you look at the exclamation point here, it will limit how much it can return based on the oldest fund. So the back test, the inception date of FXAIX, can only go as far as May 4th, 2011. So instead of showing me from 1998, it's showing me the result from May 4th, 2011 to March 14, 2025. So if you look at the performance, these 5 funds have very similar ending value. CAGR, compound annualized growth, is at 13% roughly, and money weighted return is just slightly over 13%, 13.5%. If you look at the performance graph, even though I'm comparing 3 mutual funds along with 2 ETF, you cannot see them separated because they have the same performance. And that is because all it is you have different financial institutions that created these mutual funds and these ETF, and all it does is passively track and mimic the performance of S&P 500 index. So that's why you have the same very similar performance. The same thing with drawdown. Even though you have 5 different funds, the drawdowns are very similar. And here's why I talked about no matter how the market is doing, whether it's up or down, all you care about is time in the market, dollar cost average into the market. And if you look at the drawdown here, this has a very long recovery period from December 31st, 2021. It draw down as much as 22%, and it took from 2021 all the way through December 18, 2023 to recover from this drawdown. What this single graph proof is investing for the long haul, investing in passively managed fund or ETF is 1% head knowledge and 99% stomach. How much can you stomach the volatility? And if you look at the downturn, we have more downturn and even a steeper downturn and even longer recovery period for this time frame. But yet, the performance of these funds and ETF is still in double digit. That's because through dollar cost averaging, as the market is on a downturn, you are getting more shares. And when the market is climbing back up, you have all that shares to go to work for you. I want to show the result of VINIX back from 1998. So I'm going to take all the other funds out. I'm only going to show VINIX because that's the oldest fund. $100 a week from 98 all the way to 2025. VINIX. Ending value is almost $700,000. CAGR 8.37%. Money weighted return just over 10%. And you see we had a lost decade from 98 through 2009 where the market wasn't performing well. But then the market started to pick back up, experienced a high this year. And for the market drawdown, you see over that 27 years, we have a lot of drawdowns and a long recovery period, but yet we still have a very respectable 10.25 money weighted return. Now if I put in 170 on a weekly basis, VINIX, ending value is $1.1 million. $170 a week sounds like a lot, but in reality it's not. Keep in mind this VINIX is available in some of the 401k fund. And if you leverage the employer's match, $170 a week, assuming a household of $80,000 a year, so if you have 2 people working, that's $40,000 a person, $40,000 for another person. So that's average around my area here. If you put in 6%, that's $92.31 out of your pocket. And the employer's match of 5%, that's $76.92 out of the employer's pocket. So between you and the employer match is $169.23. So $170 a week in it by itself sounds like it's a lot. But if you leverage the employer's match and take advantage of it, that's only $92 a week. And that's more like $13.15 a day. That's a value meal a day. If you pay attention to the news, it sounds bad, right? Dow Jones and S&P 500 tank as inflation weighs on consumer. Stock market news, Dow slide after latest data on inflation, consumer confidence. Dow sinks more than 700 points. Stocks are on track to the worst quarter since 2023. Barclays slashes its S&P 500 target to the lowest among the big banks. So if you read this news, it seems like the market is not investable. But if you look at how the market performed for the last 27 years, what we are seeing now, it is nothing compared to what we witnessed a couple decades ago. If you take advantage of the volatility of the market and your dollar cost average, time in the market, regardless of how the market performs, over time, the market return an average 9 to 10%. Now the ball is on your court. You can have access to the stock market S&P 500 index through any of the mutual funds that are available within your retirement plan, or You can have access to it through ETF, exchange traded fund, through any of the brokerage accounts, Robinhood, M1 Finance, Webull, Shaw Swap, even Fidelity, etc. You can do that, and you can ride the market. You can enjoy the roller coaster. No one can predict where the stock market will be a year from now, 5 years from now, or 10 years from now. But one thing is certain, over the last decade, we have experienced a wonderful bull market. Over 13% growth, that's fantastic. To be honest, I don't know if that's even sustainable. So we may start to experience some drawdown and some longer recovery period, or we may continue to experience the bull market. I don't know which one. You don't know which one. Even an expert don't know which one. But if you dollar cost averaging to the market, but if you have time in the market, if you just do it on a weekly basis, regardless of the noise, regardless of what's going on, and have faith in the U.S. companies, I'm almost certain that 30 years from now, your future self will enjoy the millions of dollars that you set for yourself.